Obasola, when we look at the stock market, we call it the golden age, was way before 2008, and then we've seen that momentum went into a meltdown. What do you think the last 10 years had been specifically for you looking back?
Well, first I would say what we call the golden age for the capital market then was masking a lot of underlining, challenges for the markets. Number one, which was corporate governance, So we saw companies, which were coming out to the market to raise capital, but without the right corporate governance and without the right, earnings fundamental. And then the pricing of securities then as well, it was a bit, overvalued, So it was a golden age, but then it was masking larger issues. And what I would say is that in the last 10 years, regulators and policymakers, they've been able to, try to make policies that would take care of some of these, bigger challenges, facing the capital market, such as corporate governance, which led to the crisis that we saw in 2008. So the market has come of age, definitely. We're now seeing much more sensible valuation by analysts in the market today. And we are seeing companies, much more forthright in ensuring that they have the right corporate governance structure.
Let's bring Olufemi Awoyemi from ProShare into this conversation. Femi, 10 years ago or thereabouts, when the market melted down, it was the leadership of the market that was in question. I remember the market memorandum just before the bull in the China shop report from ProShare. So, talk us back through that. Do you think we've been able to address some of these rules and regulation and leadership issues at the marketplace over the past decade?
Well, to start with, Omatola is precisely correct. It was in the golden age. It was a situation in which I felt that was a period in which you had a combination of regulatory inertia, malfeasance, and basically everybody just throwing all caution to the wind. And it was a period of financial exuberance. And as such, we naturally fell to the bubble, which were all jointly created by every one of us. And as you can see, we're not the only ones anyway. And globally, you will see that in terms of activities generally, everybody seems to have recovered, but not entirely to pre-crisis peak levels, especially for us in Nigeria here, where we haven't gotten to. So what is it that we have done? What are the lessons we have learned from all this is that the same situation where we got into, whereby regulation is not tackling tomorrow's trends, but focused on today's headlines, is still the norm. And as such, you haven't significantly seen any shift in the understanding of how capital formation takes place in the macroeconomy is such that we can bring into our market. The capital market, quote unquote, in a plural sense, has expanded, especially with what is happening with the FMDQ market. But the equities market has basically not significantly changed much. If at all anything, its loss is to retail fervor. A retail market which was not significantly there before. It was just a blip, but it was never really grown. And as such, we have a situation whereby what we ought to have taken from that financial crisis was the opportunity to put regulations, laws, and rules in place that allow for the new market, which we see operating currently, to emerge, i.e. things like crowdfunding, the development of collective investment schemes in such a way that they recognize risk as well, the development of things like the private equity sector, which has a better role in capital formation, and venture capitalists as well. And as such, you begin to see the fixation on looking for public offers, IPOs from companies. Whereas if you look at the macroeconomy, which is predominantly service, you haven't found new companies, which if you look at the macroeconomic framework, the GDP, as you may find, you find that you have growth in telecoms, you have growth in the arts and creative industry. But those are not sectors in which we've been able to find a way to create a financial model for which we can bring into the capital market. So we have learned a few lessons in the sense that the Nigerian Stock Exchange has similarly understood the place of data We have developed a more robust market analysis system that is not focused on the buy side only. There's also the sell side market. We've also developed instruments which basically help to dip in the market. But we're a far cry from being able to say that we have actually made any quantum leap from the challenge we've had. We still have corporate governance issues, maybe not at the scale at which we had it then, but at a much more sophisticated scale right now. And for me, I think that the major challenge is having to understand that we should create a nexus between the macroeconomy with the markets by readjusting the body of laws that seem to hold us down. You see developments in Kenya, in South Africa, from their Securities and Exchange Commission, from their stock exchanges, in terms of fintech, in terms of listing new tech companies, and we haven't been able to put ourselves in a position where we are able to do that.
You're speaking, to macro economy, making the markets. In the last 10 years, or even before, when the market momentum was there, do you think we have a macro economy that supports the Broad Street, broadly speaking, whether it's the fixed income side or mutual funds, as you talk about it, or PE, to create new economy and let the market absorb these ones and bring them in for listing or diversifying investors' portfolio and interest and money making?
Okay. No, it's not as complicated as that. The simple fact is this: if you look at the structure of the Nigerian economy, we basically have a balance sheet that focuses more on trade and exports, the more volatile side of it, generating FX, cash flows, financial services system that is structured around mostly governments and corporates. That you do not have mobilization of cash from the retail end because you have a poor insurance, pensions market, all this while. So the markets really reflect capital formation. We've tried, in as much as we want to diversify the revenue sources of government, but we also need to diversify the economic structure to move towards capital flows, i.e. foreign direct investment flows, remittances, and basically the retail end of it, which is insurances, pensions, and what have you. It is when you have such that you have a basis for you to have expectations around your equities market. I feel that the nexus between the macroeconomy has been in some ways a limitation, but most importantly, I haven't felt we've gotten our politics right in terms of how we, at the capital market, manage conversations with the government in terms of the issues they do. Every one of us know fully well the story around Safaricom and how the markets insisted that for any listing would take place. We're hearing some positive news in terms of possible a telecom listing. It shouldn't be a function of a single telecom trying to list. It must really be about us having a very broad based plan, which I think would happen. I mean, if you take simple issues around the market demutualization issue, which seems to be a protracted issue, a matter which we haven't been able to resolve, it is until you have that kind of thing take place, then the markets start beginning to earn a position which they want to challenge and discuss and engage with the government in terms of how they will grow the market. So the capital market has grown because basically we've grown the domestic bond market. We've grown state government bonds, corporate CPs market has grown, but the equities market is almost at same levels. In terms of growth.
Interesting, Femi. Omotola, we've seen the last 10 years, 2008, 2017, and of course, everyone knows that the equities market, once the poster boy of the Nigerian securities market, don't seem to be the poster boy anymore. So, do you think we have some reinvention? We've had some innovation. You think we've had some strategic direction, but the equities market need a new community of investors, a new community of products and offerings. What's your view 10 years down the line, giving us a kind of an insight into what you think we should be doing moving forward?
First, I think I want to agree with Femi's analysis. If you look at the debt market, it has grown quite a lot since 2008, thanks to the effort of the FMDQ. as well as the deeper markets, as well as the federal government of Nigeria, which has relied more on domestic funding of fiscal deficits. Then the subnationals have, as well, they've come to the market to issue bonds. And even our commercial banks, they have developed more technical ability to trade in more complex financial products such as interest rate swaps, derivatives, etc. But for the equity markets, we've not had the same story. And regarding what Femi said, the major factor holding back the equity markets has been macroeconomic stability. Because the economy because the equity market still depends a lot on foreign portfolio investors. So anytime we are having an oil cycle downturn or an upturn, it has a consequential impact on the equity market. Compare that to the debt market, where we have lots of domestic, pension funds and insurance companies who are the major players in the market. So I think for the equity markets, they must also think of a way to adopt the same strategy to have a deeper pool of domestic investors who can pick up these securities and, as such, reduce the impact of volatility in the oil market on equity market performance. Similar to that, we need to encourage more listings as well by corporates, and that could only be done if we make the environment a bit more conducive for them. Since the 2008 financial crisis, the primary market has cooled. We've seen very few primary market issuance. In terms of IPOs, we've seen more of rights issues and a couple of public offers. So, in terms of macroeconomic stability, the federal government has to do more, and the central bank as well, to improve the environment such that we do not have so much of volatility in the economy. Then secondly, we need a bigger pool of domestic investors, buying equity securities. And thirdly, we need to encourage more listings in the equity markets.